Assalamualaikum Warahmatullahi Wabarakatuh. My name is Anggun Septiarini, with NPM 244120031, from the Accounting Study Program. In this video, I will explain the definition of an account and 5 types of accounts, as well as explaining the normal balance of each account and explaining how to enter transactions into the general journal. Definition of account. Every transaction is recorded, journalized, in a journal book. Before journaling, it is a good idea to make a list of proper names. This list of names in accounting is known as an account. Accounts are a basic tool for accommodating changes and balances in each element of a financial report which has 2 sides, namely debit and credit. Accounts provide information about operating entities. The purpose of using accounts is to record data that is the basis for preparing financial reports. There are 5 main accounts in the financial statements, including assets, debt, capital, income, and expenses. The first account is assets. An asset is something that has economic value that can help a company provide goods and services to customers, either directly or indirectly. The general group of assets owned by a company describes the assets owned by the company. Assets are divided into 2, namely current assets and non-current assets.
Current assets.
Current assets are economic resources that can be converted into cash, traded, or used up over time. 1 year from the balance sheet date. The following are the names of accounts in current assets. 1. Cash is cash, checks or payment instruments that are ready and free to use for the entity's general activities. 2. Notes receivable are claims owed to creditors accompanied by a letter of promissory note to pay them. 3. Trade receivables are claims arising from the sale of services or merchandise. 4. Prepaid fees or prepaid expenses are expenses that have been paid, but have not yet been used or utilized as expenses for the entity's activities in the future or the next accounting period. For example, prepaid rent or prepaid insurance. 5. Equipment is equipment that is used up within 1 year. For example, writing tools such as pencils, pens, staplers, and so on. Non-current assets. Non-current assets have a useful life longer than 1 year. Non-current assets are classified into 3, namely fixed assets, intangible assets, and long-term financial assets. For example, buildings, vehicles, equipment, land, factory machinery, and other company bond certificates. Fixed assets are tangible assets that a company uses in the production or provision of goods or services, for rental, or for administrative purposes which are expected to be used for more than 1 accounting period, or with the explanation that the tangible assets owned by the company have benefits for more than 1 year. Intangible assets are assets that cannot be physically seen. Examples include goodwill, copyright, patents, and franchises. It is very difficult to precisely measure the value of intangible assets. Presentation of assets on the balance sheet in order of liquidity. On the asset side, cash is the highest order of liquidity in the balance sheet, so it is placed at the top and then followed by the balance sheet, inventory, and others whose liquidity order is lower. Liquidity here is the ability of the asset to be immediately converted into money or cash. Long-term financial assets. One form of long-term financial assets is long-term investment. Long-term investment is long-term investment to obtain fixed income, in the form of interest, and variable income, in the form of dividends, as well as to control other companies. The second asset is debt or liability. Debt is a company's obligations that arise to third parties that must be paid by the company in the future when the debt matures. A company that borrows money from a bank, creditor, then this money loan, debt, is included in the company's liabilities. Due to this obligation, the lending party, creditor, has the legal authority to collect its rights in the form of debt repayment. Liabilities are also divided into 2, namely current liabilities and long-term liabilities. Current liabilities usually have a maturity period of less than 1 year, while long-term liabilities usually have a maturity period of more than 1 year. The following are examples of short-term debt or current liabilities. 1. Trade payables are the entity's obligations to creditors which arise due to transactions purchasing merchandise on credit. 2. Notes payable are an entity's obligations to creditors accompanied by a written promise to repay them. 3. Salary payable is an obligation that arises because there are employees who have worked but have not received salary payments by the entity. 4. Tax debt is a debt that arises because it is time for an entity to pay income tax, but due to other reasons the tax has not been paid. 5. Unearned income is income that has been received in the current period but has not provided services. For example, rent received in advance. The following is an example of long-term debt or liabilities. Bonds payable are long-term obligations of an entity accompanied by a certificate of outstanding debt and written form on a stamp. The third account is capital. Capital or equity is the remaining right to company assets after deducting all liabilities. M.S.Ak. Another term used is stockholders' equity or shareholder capital. Share capital holders represent the net assets of the company or the total book value of the company. Book value per share is the total book value divided by the number of shares outstanding. Therefore, it can be said that the company's assets can be claimed by two parties, namely the creditor and the owner. Equity consists of capital and retained earnings. Capital can be obtained from company owner funds or from the release of company shares to investors. Meanwhile, retained earnings are the company's accumulated profits that are not distributed to the company owners. Fourth account is revenue. Income. Revenue is an increase in the number of assets as a result of gross company operations. Income is obtained due to the delivery or sale of goods or services in one period. Income is divided into two, namely: 1. Business income is income obtained from the entity's main activities in the form of service income and sales of merchandise. 2. Non-business income is income originating from activities outside the main business. For example, dividend income, interest income, and rental income. The final account is expenses. Expenses are sacrifices that occur in order to obtain income. Expenses are also divided into two groups, namely: 1. Operational expenses. These are expenses incurred in order to obtain operating income, for example, salary expenses, rent expenses, advertising expenses, and so on. 2. Non-operational expenses. These are expenses that occur not due to the company's main activities, for example, interest expenses and bad debts. The normal balance of an account is the normal balance of each account with the aim of showing the general condition of the balance of the accounts, both on the debit side and on the credit side. The normal balance affects the increase or decrease in an account. 1. Asset accounts have a normal debit balance so that additions increases to the balance are recorded on the debit side. Conversely, a reduction decrease in assets is recorded on the credit side. 2. Debt and equity accounts have normal credit balances, so their values are presented on the credit side. Additions to debt and equity accounts are recorded on the credit side and deductions are recorded on the debit side. 3. Capital or equity accounts are influenced by income, expense, and private accounts. Income adds to equity so that if there is an addition increase, it is recorded on the credit side and a reduction decrease is recorded on the debit side. 4. Expense and private accounts are accounts that reduce equity and have normal debit balances. Additions, increases in expenses and privileges are recorded on the debit side, while reductions, decrease, are recorded on the credit side. Recording or general journaling of transactions must pay attention to the debit and credit sides. The debit side is recorded first and followed by the credit side at the bottom slightly to the right with the same value, amount. In order to avoid difficulties and errors in journaling, you must first understand the normal balance of each account. Thus, it will make it easier to place each account. That is, whether it increases or decreases on the debit or credit side of a transaction. There are several steps during the journaling process, namely: 1. Identifying or understanding transactions that occur from document sources in accordance with the principle of objective evidence, transaction evidence. 2. Determining the accounts related to the transaction and classifying the accounts. That is, whether they are included in the asset, debt, equity, income, and expense groups. 3. Determining the consequences that occur in each account as a result of the transaction. That is, whether the account has increased or decreased. 4. Determine whether the account has increased in debit or credit and record it in the journal and provide a brief explanation under the journal.